Hey, what's up, guys? Wanted to say what's up. Victor Bell. On today's show, I wanted to go over a couple of things about the thing that I look at quite a bit, and it's on every headline of every article you can read right now. And it's about debt, it's about mortgages, it's about interest rates, about real estate, all of that. But the thing I wanted to go over today with you guys is multifamily apartment building debt, how to get the best debt, even in an environment like it is today. So, if you guys don't know about me, my name is Victor Bell. I've been investing in multifamily and residential real estate for over 20 years. And the thing that I would love the most is multifamily property. It is the number one way to build wealth, generational wealth for you, your family. And that's what we do in my company also over at Bell Capital is we help the regular everyday investor get access to multifamily properties that you would normally not be able to get. But today I wanted to go over a couple of things with you. It is really the 4 things that you need to know about how to get good debt. All right, on multifamily property. It's what I see happening, and I want to kind of go over that with you guys. So one of the bigger things about me, why I resonate with a lot of people, is because I got started like everybody else did in real estate by buying single family houses and small multifamily properties. And maybe, in 07, 08, when everybody else was kind of going through their problems, I had bought a 40-unit apartment building. That thing did not do well. It was a heavy value add, heavy lift. I went against all my personal investment principles about not buying bad properties in bad areas or major fixer-upper deals because I don't do that kind of stuff. I'm not a wholesaler, contractor, whatever. I had to start looking in my own backyard in Hawaii. So I bought a few apartment buildings in Hawaii, but one of the main things that I know, because prior to that, I did a lot of creative financing stuff. When you buy multifamily property, one of your main partners and investors is going to be the bank. It's going to be a bank. It's going to be a commercial mortgage broker or lender. It's going to be a regional bank. It's going to be institutional capital, a debt fund, whatever. But that is your partner. So the debt inside of these apartment buildings are going to be vital. Let me show you something real fast before I go into the debt thing, why this is important. Like, even if you're going to take a look at property, this is one of the deals we've been chasing down. And I want this property for the fund really bad. I'm going to get this property, made an offer on it. We continue to kind of go back and forth with the owners on this deal, try to get in contact with them around accepting our offer that we sent over. But here's the deal with real estate. So if you're going to look at all real estate really consists of 2 things. It consists of debt, right? And it consists of equity. Equity. Boom. Those 2 things make up any real estate deal. All right. So in all situations, and this is what I like to explain to people so you guys understand these steps about how to get good debt and why this is important. Because on the debt side, a bank, you get this money from a bank. This is the best money in the world. It's solid. It's everything. Now, today's world, this debt can run anywhere from 5.5 all the way up to 9%. That's what it costs today, right? But just December or so last year, this debt was about 3%. 3%, that's it. Now, I think it's going to go back to about 4.25%. This is pretty much what it's been historically so far as residential, for commercial debt for multifamily. But on the average, it ranges in between here. But this right here is where you come across partners, whether that's an institution, whether it's like a Goldman Sachs, or it's going to be one of the other KKR or Blackstone, all these other people. But either way, this is your partner. This is the number one thing. So if you're looking at deals like us, like deals like this property here, like this apartment building, I'm going to push that back because I want you to see it. You look at something like this 100% has debt on there. So don't think, guys, if you're taking a look at apartment building investing, guys like myself who are fund managers, we have a $50 million equity fund. Like, we are looking for deals, but no matter what happens, we look for debt. Now, there's a difference between debt, good debt, and bad debt. I know when you were growing up, your mommy and your daddy was like, don't get into debt. That's credit card debt. That's consumer debt. That's buying your own personal home where you have to be the person that's paying for the debt. This debt, we're looking at this because tenants pay for it. All of our tenants are going to go through and they're going to pay their rent every month. And that's where the income comes from to pay on this debt after we pay the expenses. So, like we said, debt. How do you get good debt? So the number one thing, and you guys hear me talk about this all the time, and I'm a big advocate for this. When I'm looking at debt, number one thing I'm looking for, how to get the best debt is how to get you got to focus on the deal. Number one thing you're looking at is the deal. You have to find the best deal, right? So finding the best deal doesn't always necessarily mean the best property. right? You want to get a great piece of real estate. You want to have the best property that you can, but primarily you want to be at the best location. For example, this property right here, location is sick. This is a multi-million dollar location in San Diego, and this property pushes up right across the street from it, right? It is a multi-million dollar, it may be even in $1 billion location, like all of the money that's flowing through this area. So the way to get the best debt is always try to look for the best deal. And your best deal is always going to be associated with the best location, right? I was talking to my cousin last night and we were talking about all the deals that we've done. And every one of those deals, the location was irreplaceable. You could not rebuild that location. You couldn't replace that location. It was always going to be desirable, not just by me, but by banks, by other Blackstone, by BlackRock, by all the other major players in the real estate industry. So the deal is the number one way to get the best debt. It doesn't matter what the interest rate climate is. Yes, it affects the offers, but the best debt is always going to be attracted by the best deal. All right, number 2, your NOI. That is your net operating income. So if you guys go back to my other videos, I go over how to find the net operating income in apartments and multifamily properties, right? I'm taking Castle hat off. But this is how you get good debt. When you have the right NOI, NOI basically in the end, the deal has to be cash flowing and there needs to be some upside to it, right? When I look at any deal, even though I'm looking at possible upside to the NOI, is there anything that I could do to raise the income of this property over time? I look at a worst case scenario, right? Because I'm always like, okay, look, I'm not super intelligent and super smart, but I know real estate like the back of my hand. I'm a great picker. I'm probably the number one picker, I think, for apartment buildings in like Hawaii, California. I can take a look at a deal and go, that deal is going to always make money. That's a great deal. So, but when I look at it, I still play the worst case scenario game. What happens if this thing goes sideways? What happens if people stop paying their rent? At what point does the NOI on this great deal, great location, at what point does the NOI start to slide a little bit because we can't keep tenants? What happens if there's damage or fire damage or something? Like, let's say on this property, let's say this building burnt up and we only have this property. What happens? Can we still get the right debt? Can we still cover our costs? What is it going to take? Who are going to be, like I said over on this page, will our debt partners get what we're trying to do if something went sideways on this property? What happens if we can't do any better than the last owner, right? So I'm always taking a look and say, hey, I'm going to take a look at the NOI on this deal. I'm like, hey, does it cash flow today? What if it never cash flowed anywhere past where it is later? And what is the upside? What do we think we can do? And let's start kind of testing that. That's how you also get the best debt. That's how I do it when I'm looking at debt and I'm talking to my debt guys. All right, number 3. That's when I bring in debt, right? I start asking, hey guys, how's the debt market looking? We're looking at a deal right now. Could you guys, what it's called, size the loan? Could you size the loan? Could you start telling me what all the different options that I have, whether it's going to be with a debt fund, whether it's going to be with a life co, whether it's going to be with Fannie or Freddie Mae, which is agency financing, whether I'm going to go to like a local or regional bank and start talking to the bankers there, or I'm going to talk to a commercial lender or commercial mortgage broker, and he's going to go out into the market and find out, hey, Vic, here's what we think about rates. Rates are 5.5% with Freddie Mac. Rates are going to be anywhere from 8 to 9.5% for debt funds or life co or whatever the spread is in the moment. But this is how you start to take a look at. And the reason why I have how to get good debt, looking at the debt is number 3, is because getting the debt and looking at great debt, how do you pick? Debt itself, leverage, is a product. So all you guys out there, don't get debt, to get out of debt, you owing on your credit card because you banged it and you bought a bunch of shirts or you went on a vacation, is not the debt that we're talking about. That is going to be the partner on a multifamily deal that we're looking at that's going to make us all financially free and help us hit our returns based on investments, right? That's very different. So, and then last but not least, 4, and I looked at that because I want to make sure I don't miss it because I had some bonuses. The right exit. So the exit of your multifamily investing and the debt are tied together. So right now, and I want to share this with you guys because this is important for you guys to know. Right now in the market, there's going to be great deals coming to market. A lot of properties that would have never come to market are going to shake loose, not by the little guys, but by big guys, syndicators, fund managers, people who have big portfolios, apartment groups that own a lot of apartment buildings that their debt, the debt piece is maturing because they didn't anticipate the debt going from, like I said before, from 3% to 4.25% to now 5 to 9% and above. So you have a lot of big players that their properties are not, they're going to have to either sell their properties at a discount, right, based on the debt that they currently have, or they just got to get out because they got to pay their investors back. So these things are actually tethered together. So first you look at the debt and you say, okay, I can get this debt for me. When I look at debt, I'm looking at long-term, right? 7 to 10 years if I can get that with the right rate, with the right property that I'm looking at, with the right income, and knowing that, hey, if I get a long-term debt on this deal, I'm looking at the upside, can it get hit? I'm looking at current cash flow, can it get hit? And I'm looking at worst case scenarios with the lifetime of the debt that I have. Let's say it's 7 years. Let's say it's 10 years. Let's say I got to go 7 years and then extend for another 3 because we're looking at what's going on in the world in the future. I got to understand that. That's how you get the best debt. You start to kind of play that game. Now, when you understand the rest of like which one, you look at your exits. Am I going to resell this property? Do I want to refinance this property? Are we going to keep this property in our fund and refinance, cash out, pay all of our investors back their money, and then hold this property long term? So, like I said, when you look at the deal first, this is why the deal is first. I would keep this property in the fund for a long time. We would take down this property. We would close this property. We would manage this property the right way, raise the NOI, and then as we're able, refinance and take out our down payment, take out the equity, pay my investors back. And we would stay in that deal for another 5-7 years or whatever that is. And then later, when we decide to exit, which is a plan, we can either resell for double or triple what we had in it, even though we're at an infinite return because we have no more money in that deal. And we can take a look at the debt at that time. Hey, is it worth doing? Can we refinance, pull out money, or is this the time to go ahead and resell this property, right? Or can we just hold on to it? Let's say we don't pull out any more money because we already got our money back, but we refinance based on the interest rate, but we don't pull out any more money. We just reset the clock and we lower our interest rate, which boosts our NOI again, or it boosts our cash flow again after our NOI, because now we owe less, or we're paying less money on the debt. So all of this stuff is dictated about how you get the best debt. Because let me tell you guys, to get the best debt for multifamily property like this is the multifamily property I'm talking about. I'm not talking about duplexes and triplexes and fourplexes and sixplexes. I'm talking about a deal that can actually change your life. When you start looking at that kind of debt, commercial debt, you really play the game differently when you start thinking through what you're doing. All right. So number one thing I'm looking at all the time, guys, and I want to share this with you because I want you guys to think about, this is how we do it. This is how I pick deals. This is how I look at the debt that I'm looking at for the deals that I'm bringing to our investors for Bell Capital. Number one thing is the deal. The location has to be sick. The location has to be irreplaceable. The deal itself needs to be a great deal, great looking piece of property. People want to have to live there. Not a lot of deferred maintenance. It needs to be somewhat stable. Next, I look at the net operating income. How much is the property itself producing over its expenses? And hey, which is really the cash flow of the property, right? So then next I'm like, okay, what's the worst case scenario of this deal? If I suck really bad and I can't manage the manager and we can't do anything, can we live with the current NOI based on the amount of debt next that we can get on this property? Next, I take that same NOI with my worst case scenario, my potential upside as is for where it is today, and then I go to the debt side and I go, hey guys, what do you guys think about this property? Could you size the loan for this deal and let me know what's available so I can see what's out there? So they bring that back to me and I take a look at all those different options. Hey, Vic, you can do a 7-year, you can do a 10-year, you can do agency, you can do life company, life insurance companies, which actually fund multifamily deals. We can do a debt fund. We can do that. They're going to Wall Street and they're finding all this potential they're finding all this potential debt to fund the real estate, right? Up to a certain loan to value, maybe 60% or 50%, 75%, depending on where they're at. And then next, I weigh up what they tell me, my debt options, up against all the exits. My ultimate, and what I always have done, I've bought the property, I've refinanced the property and done a cash out, paid my investors back their money, and then we stayed in the deal, and then we stayed with the new financing, we stayed in there for another 5 to 7 years, and then we resold the property for double and triple what we had in. So it's an infinite return for my investors, but we also pulled out our down payment. So we took away the risk because they got their money back and they still stayed in. They still got cash flow. They got the upside. They got the tax benefits, as well as when we sold, they got more money. Man, it's amazing to be able to do that. But you got to understand that's the exit for me. All right. So even if we keep the deals even after that, because let's say we don't sell and we just keep refinance, cash out, pay my investors more money, no taxable event, and then we keep the deal. So we keep the deals cash flowing, they pay. That's an exit. But that's based on what my first level of debt is. Like, this is what my options are as it relates to the financing and the debt. And then these are what my exit strategies are based on where I want to go in the future. Can this deal support these two things? And if it can, man, it makes sense to do. So this is what I look at when I'm looking at debt as it relates to multifamily investing, apartment for Bell Capital, how we're looking at doing deals with myself and my partners, people who are coming in and want to invest with me. But so you guys understand, I do this so you understand how I make decisions. It helps so you know, as me being a syndicator, fund manager of multifamily and apartment buildings and being a potential investor for us with me as a partner, how Victor looks at things. This is how we're going to secure great debt, even in the not the best debt climate, not the best interest rate climate. Like, that just makes me be a lot more aware of what's going on. We run our numbers differently. We talk to more debt people. We talk to more commercial mortgage people. We talk to more bankers and stuff. But we never stop looking for deals. Just because the debt isn't the best right now doesn't mean that there's not going to be great deals out there. Because I'm seeing them, and they're starting to come available more and more and more by talking to the right owners, talking to the right people. That is going to be great. So if you're going to do this yourself, you need to keep this in mind. Number one thing to get the best debt, you got to get the best deal. And that's based on the location of the deal itself right here, based on the location. Next, you got to focus on the NOI. What is the NOI of the property? Can it support getting great debt, no matter what that great debt is? Next, get an idea of what all debt looks like for you and that specific property that you're looking at. You need to talk to somebody that's going to be a partner in your debt, on the debt side, on the financing pieces. And then last but not least, you need to weigh up the debt and your exit strategies together. These two are probably the most important part. Where is it right now and where's it going to be in the future? Because they actually are tethered to each other. This is really what's happening out there in the market. People don't really get that. So I'll make a video on that one day soon. But anyways, man, thank you so much for tuning into this. I wanted to make this video so you really understand how I look at the debt side, how I look at what debt is and how to get the best debt. And let me tell you, the number one thing about getting the right debt, you got to get the right deal. Got to get the right deal, got to get the right location. You got to be a great guy that understands what's going on, how to manage the manager of these properties, especially if you're going to be raising money from investors, or like, I would rather you guys invest with me. If you're out there, you're looking for deals, don't do the 4 families and the duplexes and triplexes and these little small deals right now. If you have money to invest, you're accredited, hit us up over at Bell Capital. Just reach out and talk to me. Me or somebody on my team is going to answer your questions. We're going to help you, guide you through. If you have a personal situation, I want to talk to you. I want to meet you. I want to get a better understanding of what you are trying to do based on investing so I can see if it can be a fit for us, man. I really want that. I want to help you. All right. So I hope this video served you. How to get great debt. The 4 things that you have to do to get great debt in this market or any market whatsoever of what's going on. But like this video, share this video, give it a thumbs up, give it a thumbs down if you hated it. Don't be a hater and a hider at the same time. Super important. I want more people to see these videos, to share, to subscribe to my YouTube channel. And I'm looking forward to helping you guys. Or you could go to bell-capital.com and you can schedule a call with me and I can go through exactly how this works. And I'm looking forward to having you guys, seeing you guys all the time. Let me know if there's anything you can do. Boom.